Hello and welcome to 2 Minutes about Brexit. Today we are going to discuss what does the UK election outcome mean for Brexit, but also for the economy, companies and markets. I'm BOATA, Head of Macroeconomic Research at Euler Hermes. So the UK election outcome was very welcomed. The solid majority of the Conservative Party actually brings us more confidence that the UK will be able to deliver Brexit in 2020. What does it mean? It means that we expect a ratification of the Brexit deal by the UK Parliament, but also by the EU Parliament by June 2020. So actually we expect a technical extension from the end of January towards March or June 2020, because we consider there's not enough time to debate on the Brexit deal that has been already approved in principle by the House of Commons. And also we don't think there's enough time to leave the European Parliament have a time to ratify it. The next steps in terms of Brexit would be the trade deal with the European Union. After the Brexit deal is ratified, a transition period will be in place. A transition which means nothing will change. The UK will continue to trade with the EU under the same conditions. However, it means that until end of 2020, when this transition is planned to end, they will need, the UK and the Europeans would need to have technical aspects of the implementation of the dual custom union in the Irish Sea ready. And we don't really see how this can be done in less than 1 year. So basically we would expect to see an extension of the transition period until the end of 2021. However, we should acknowledge the fact that a solid conservative majority means lower political uncertainty in the UK, so relatively low risk of early elections in the next 2 to 3 years, and it also means more fiscal spending. So we have actually upgraded our GDP growth forecast for 2020 from 0.8 to 1, and we expect 1.6 in 2021. Definitely the risks are not over, so we see that there are already debates on the end of the transition period and the trade deal with the European Union, but we also see that there are risks to see another referendum in Scotland. So the volatility will be there, but overall we should not see extreme risks that we have seen in 2019. However, in terms of what does it mean for companies, we should still see a period of adjustment. 6 months still, where the companies would need to get rid of the contingency stocks that they have built in 2019, and that they continue to be at very high levels despite the recent adjustments. And we think this would take more time to be absorbed. So overall, we don't expect a growth acceleration, neither an acceleration in turnover growth for companies, nor the downside pressures on margins to finish until H2 2020. In terms of markets, it means a positive because we have lower uncertainty, but we won't expect a strong, let's say, rally in the domestic equities, nor any significant impact on interest rates, because we live in an environment, global environment of very low interest rates. But we expect a bit more upside pressures on sterling, and we expect it to prevail around 120, 125 compared to the euro until the end of 2020. So if you have watched us on YouTube, please subscribe to our channel, or if you're on LinkedIn, follow us. We will try to answer to your questions. Don't hesitate to ask them below, and we will try to be as quick as possible. Thank you for watching and see you next time. Bye.